Now we have Blu Putnam. He's the chief economist at the CME Group, joining us to talk Fed. Blu, thanks for giving us part of your afternoon and joining us here in studio. Let's get right into the Fed's decision to leave rates unchanged. As expected, your initial thoughts?
Well, they did more than leave rates unchanged. They actually raised the interest rate all of 5 basis points on the interest they pay. The Fed pays commercial banks on deposits that they held. That's the interest on reserves. And they also extended their program to provide buy short-term treasuries and repo activity to calm and keep calm the overnight money markets that had spiked back in September. So there was a little bit of action below the surface. Not that the equity indexes care, but if you're in the technical side of the business, there was a little bit of activity.
Yeah, can we slow that conversation down a little bit for our viewers who aren't familiar with this discussion? We've had this multiple times in terms of some of the concerns, the liquidity concerns basically is what you were touching on, and how the Fed is purchasing short-term treasury bills at a rapid rate again at $30 billion a day, building up the reserves in the banking system.
Yes, the Fed seems to think it's their responsibility to make sure there's not too much volatility in the overnight money markets. We used to have quite a bit of volatility in those markets back in the 90s when Greenspan ran the Fed, but this Fed feels more that it's their responsibility. So they've taken that on. They've expanded their balance sheet, and it doesn't really affect big macro activity. But if you're funding overnight positions, say you're a hedge fund or something like that, you do care about the fact that now you're being protected by the Fed.
Yeah. What kind of position does this put them in? Because this is not necessarily in their mandate, correct? I mean,
this is definitely not in their mandate.
I mean, this could be a sticky situation if things were to all of a sudden get worse. It sets precedent basically for action, and if they need to really act, would they be willing to?
Well, it's interesting as to why they're so concerned about a risk that they probably don't all that have to worry about. I mean, we did fine in the 90s when it was more volatile. So, but what they're really probably looking at is the secured overnight funding market and thinking, well, maybe down the road we might want to target that rate instead of Fed funds. Fed funds don't trade very much anymore. $75 billion a day, whereas the secured overnight funding market is almost $1 trillion every day. So the Fed is looking down the road, thinking about targeting a more robust representative market rate. And so now they're concerned about, can they control that rate? How steady is it? Looking at the characteristics of it. So we're in the weeds here today.
All right, let's talk about today a little bit in terms of a unanimous decision to leave rates unchanged. You mentioned again some of the changes that they made in terms of raising interest on the excess reserves rate to 1.60. Let's talk about the comments or expectations that Fed Chair Jerome Powell, he's going to be asked about this 2% inflation target. Now, last week we heard from the ECB, they're actually reviewing their policy. They said it could take up to about a year, and they may reevaluate that target. But I'm wondering, I guess, should the Fed reevaluate or reassess that 2% target? We fell short for a long time now.
Well, I think they probably will reassess that target. There are a number of studies going on within the Federal Reserve System to review inflation targets, just like the ECB. The thing is, we've been between 1% and 3% core inflation for 25 years. Interest rates up, interest rates down, market up, market down. The Fed can't control the inflation rate anymore. And so they probably should think about widening the band on that target, which they've effectively done because they've told us if we overshoot on inflation, they're going to let it go for a while. They're not raising rates. So they've already basically created a band around that inflation, but the Fed has to come to grips with that they don't really control or even much influence inflation anymore. So it's hard to target something you don't influence.
Yeah, when I hear the Fed willing to, or seemingly willing to see inflation 2.2%, potentially even 2.3%, as we've erred on the downside of that 2% fulcrum for a while now. But I'm starting to wonder that's a very, in theory, a very dovish type statement in theory. I guess I'm curious, what could the Fed say today that could concern the markets in terms of a hawkish statement? What could put the Fed into the corner where the markets can interpret his comments as somewhat hawkish? Maybe he could say something like no cuts to come for the next 2 years or whatever it would be, or the no cuts to come comment specifically.
I don't. This Fed is not hawkish. This is between a neutral and a dovish Fed.
Yeah.
And the fact that these votes are unanimous now, because last year they weren't unanimous. They were 2 or 3, usually 2. FOMC members dissenting, but that's because they wanted to go on hold. They didn't want to raise rates. They just wanted to go on hold. Now everybody's come together at the current rate, unless economic data changes. So, and they're only looking at data getting worse. That's the only thing they're following. So if unemployment went above 4% and looked like it was going to go toward 4.5%, then rates are coming down, and they're not coming down in 25 basis point increments. They're coming down fast.
Yeah. Blu, do you see that happening? I mean, the labor market's been very tight. We've seen some softness, a little bit of softness in terms of manufacturing, but you said you don't see that happening.
No, I mean, 2020 from a point of view of economic activity is a pretty boring forecast. You know, 2020 has 2 twos, so 2% GDP, 2% inflation, or a little less. I mean, but we're not really, the catalyst that could trigger a recession is not there. So at least for now, the Fed's in a sweet spot. They're in neutral. They like where they are, and they're data dependent again.
Okay, sounds like you're not too concerned about the coronavirus and the spread recent there, so we'll move past that. But let's talk about a potential catalyst that could trigger a recession. We heard about interest rates inverting this week again. You laughed at that a little bit. We've talked about that before, not a major concern for you, but do you have any recession concerns out there?
Well, you know, I got a long list of things I'm worried about, but the probabilities are all really low. Okay. So I'm more confident that we're going to get through 2020 without a recession than I have been, say, compared to last year. I'm more confident. But let's talk just a little bit about why the yield curve is flattened. So we did have a reaction in the oil market and the copper market to the coronavirus. So those things are. Oil and copper, what China buys a lot of.
World's largest importer of copper.
Exactly. Right. So those are the markets that are in the headlights. And we did have a little bit of response in treasuries where we got lower yield. So if the 10-year note yield goes down a little bit, that does flatten the curve. Okay. And it makes people, you know, take another look at the yield curve. But I think if that's the reason the yield curve has moved, that's not a cause for concern.
All right, we'll continue to watch the yield curve. We'll continue to watch comments as they come across the wire from Fed Chair Jerome Powell. Here you can see the 30-year all the way down into the 5-year. Actually, the IRX is listed there as well, but definitely something to keep an eye on. Blu, we really appreciate you joining us. A great breakdown in terms of the Fed, what to watch for in the coming weeks and coming months, and appreciate you giving us part of your afternoon here on a very busy Fed Wednesday. Traders, that's Blu Putnam. He's the CME Group's chief economist.